good night, wherever it is that you are, night, morning, wherever it is. What's good, guys? So, really quick, and giving it back to Junior, putting together this event that we have up and coming here. It's definitely an event where last time that we had something like this, and we were doing the different calls leading up into the event. But when the event actually happened, the feedback that I got from tons of different students saying how like, yo, this is one of the best events that I've actually attended, being a part of the community, being a part of the platform that we were running. And so I just want to really give it back to Junior for, doing all this, putting this all together, getting all of these beast educators, right? These beast educators in the markets together here in one place to give you guys as much value as possible. So definitely let me get some threes in the chat for Junior. My guy has done it again. You guys are going to get tons of value, not just from this training that we're going to be doing here today, but hopefully you guys locked in your tickets because the Blueprint Wealth Conference is going to be, I know it's going to be absolutely insane. But before we get into what it is that I have to go over here today, I just kind of want to get an idea of some of the people here on the call. Now, I know a lot of you guys are familiar with me, you're familiar with my style of trading, but let me get a one in the chat if you're not really familiar with my style of trading or you don't really know my exact like approach or system, or if you're just kind of new here, it's kind of new. Okay, solid, solid. So a couple people, right? Now, a lot of you guys that do and that are familiar, I'm really known for the entries that I'm able to get on gold. Gold's Bay, right? Gold is definitely Bay. I saw someone in the chat say a couple people in the chat say Gold's Bay. But there's a method to the madness. So a lot of you guys here tonight are probably wanting to know how can I get precision entries? And honestly, in this industry of trading, that is a major thing. That's a big thing. That's a big thing that a lot of people seek, that a lot of people want. A lot of people want to know how to do. How do I get the best entry, right? Like, how do I, when I see someone on that very bottom wick or that very top wick, how do I get that, right? And that's what a lot of people try to chase or they focus on. They make it about that. Like, how can I get the best entry? So, if you guys want to know the keys to precision entries, let me get some type of energy in the chat. Let me get some fires, some conches. If y'all want to know the keys to precision entries on this call here tonight, and y'all want me to lay it all out on the line, right? Fire, fire, fire. You guys are ready. So if you're ready, make sure you have a notebook, okay? Because it's going to be a couple things that we're going to have to go over here. Um, but with everything that we're going to go over here tonight, truthfully, the precision entries is going to be the least important thing. One thing Junior mentioned is creating some type of consistency, be able to create consistent results in the market, right? And this is a common misconception. I'm going to pull up my screen. I like yeah, I like using TradingView as my canvas. I'm very used to doing that. So that's what we're gonna do here tonight, okay? And this is what we're gonna do. Just gonna lay this out. We're gonna just get right into it, okay? The key to precision entries, right, is going to be aligning the higher time frame structure with the lower time frame structure, right? That's it. I mean, honestly, that's like really it. This is a major key when it comes to precision entries. But like I said, us getting these precise entries is going to be the least important thing when it comes to everything that we're going to talk about on the call tonight because a common misconception. in this niche is that precise, all right, precision entries, all right, equals, all right, consistency, right, or profitability, right? I'm not the best speller, so good thing you don't need to know how to spell to trade, right? But this is a common misconception here. Precision entries equals consistency, right? Or profitability, okay? And this is not true, okay? And so if the end goal is to be able to produce some type of consistent results. If the end goal, right, let me know in the chat if that is an end goal for you. If you want to be able to produce some type of consistent results from trading, right? Let me know in the chat. Is that not the end goal at the end of the day, right? We want to be able to create consistent results for ourselves in the market, right? Exactly. So if that's the end goal, we need to understand, okay, what's a formula that can help us get to that end goal? Because this is not it, right? This is not it. This is not the final piece of the puzzle. Okay. Now, precision entries is going to help, right? And we're going to talk about this. We're going to talk about aligning higher time frame structure with lower time frame structure. And I'm going to give you guys some concrete things that y'all can do as far as actual rules that I follow when it comes to this. But none of it is going to mean anything without everything else, right? We need to know the whole formula. When it comes to trading, the way that my mind works, I like to look at it like a formula, right? There's a formula or an equation, if you will. Okay. And precision entries, being able to have precise entries and exits is going to fall into the strategy portion of our overall formula or equation to create consistency. Okay. But this is going to be my formula here. Okay. This is what works for me. And I think a lot of other traders can also agree with some of these things that I'm about to list out here. But strategy, okay, plus risk management times discipline, right, and reflection equals consistency. This is the full formula, okay? Strategy plus risk management times discipline and reflection equals consistency. Okay. And so we need to break down and dissect each of these because if one of them is out of whack, then we can't complete the formula, right? We can't get to the end goal, right? If we don't have a strategy that we're going to follow, some type of methodology, some type of something that's going to give us an edge in the market, right? That's what you guys learn from me on the Zenride platform pretty much, right? Multiple times a week, right? 4 times a week, okay? So we're going to touch on strategy, but we're going to save that for last because, again, it's the least important part of this formula. Okay. Risk management, discipline, and reflection. Let's start there. Okay. Because those are going to be the things where most people struggle, right? How many people in the chat currently feel like they have a good strategy or they have traded a good strategy before, right? You could just answer in the chat if you feel like you've found a good strategy before or you're currently using a good strategy. Okay. Solid, solid, solid. Now, out of those same people, how many people find themselves, even though they feel like, hey, the strategy that I have is good. The strategy that I have, it makes sense. But out of those people, how many of you guys still have not been able to produce the results that you're looking for, right? Out of the people that answered in the chat, right? Let me see how many of those people drop numbers here again. Okay, solid. So this shows us that just having a good strategy is not enough, right? And a lot of people think that that is the missing piece. That is the missing piece when it comes to them being able to produce the results that they want in their trading. But most of the time, the biggest things are going to be the risk management and the discipline. We're going to talk about reflection as well too, because that's going to be very important to be able to progress and continue to grow as a trader as things change over time. Right? I've been trading in the markets for about 10 years. Right? It's going on 11. And anyone who's been trading for 5 years or more, I'm sure you guys can agree with me. The markets are not the same today as they were 5 years ago. They're just not, right? The markets have changed. The markets are more volatile. The markets change because the markets are a reflection of us, right? That's something that I truly believe. The markets are a direct reflection of human consciousness, human interaction, human emotion, right? And so if we as a people are changing, right? We as a society are changing, things are becoming more volatile, et cetera, et cetera. The markets are going to reflect that. So reflection is going to be very, very important. So we're going to touch on that. But first, we're going to talk about risk management, right? And this might be one that a lot of people feel like, oh, okay, I already understand risk management and I already understand risk and reward. I understand how to do these things, right? But do you really? Do you really understand it? Because if you did, you would know how much of this portion of trading is going to contribute towards whether or not you are profitable, right? Because this is one of the only professions that we are in where we can actually set the stage up for ourselves to be able to work smarter and not harder, right? Some people in their trading, they're currently fighting an uphill battle and they don't even know it. They have no idea. They have no idea that what they're doing in their trading, the numbers are working against them, right? Now, you don't need to be good at math or good at these things to see consistent results in trading. But the bare minimum that you can do is you want to understand the bare minimum of understanding risk reward and risk management and how you can set the stage up for yourself so that you're not fighting an uphill battle, right? So this here is something that I came across a couple years ago, right? And ultimately this changed the game, right? Combined with, a proper strategy as well, too, discipline and reflection. Okay, so let me just pull this up here really quick. And I'm sure some of you guys have seen this here before, but this is what changed the game for me. Okay, understanding this and really understanding risk to reward is not working for you if you're not using proper risk. Okay. Because we see this chart here and it makes sense to a lot of people that, hey, if I go after higher risk to reward, I don't have to, and they look at it and it's like, okay, I already understand that, right? But is it truly working for you? Right? Is it truly working for you in the sense of how consistent is your risk for this to work in your favor versus for it to work against you, right? So ultimately, we already know, a lot of people know, and I mean some people don't know, right? So let me not say that. Some people don't know. So we'll run through the entire chart, okay? The lower your risk to reward, the higher your win rate needs to be in order for you to create profitability. Okay. What does this mean? So on the left here we have risk, right? Risk to reward, and on the top here we have a win rate. Now, chat, and this should be a pretty obvious one, right? Chat, I want to know, would you rather have to be right all the time to make money? Or would you rather be right some of the time and still make money? All right. Let me see in the chat if you care about being right all the time. What do you care about being, right all the time or some of the time? All the time or some of the time, as long as I still make money. All right. Because a lot of the times we focus on win rate too heavily. Right. A lot of times we focus on like, yo, I need to have that 70% win rate, right? Yeah, Chris, all the time is nice. Well, we're gonna touch on that too, because that's when it gets really fun when you get in the upper percentiles of win rate, but you're also using a good risk to reward. Okay, and so the lower the risk to reward, if you are risking or targeting the same thing that you're risking, so you're going after a one-to-one risk to reward, then you are going to need to win at least 60% of the time to make money. Okay. I'm not going to go into all of the math for time purposes, but you guys can fact check it and back test it yourselves. But you're going to need to win 60% of the time to make money, right? Because if you win 50% of the time, right, you take 10 trades, you risk $10 to make $10, right? If you win 5 times, you made $50. If you lose 5 times, you lost $50. You're at break even. So you need to win 6 out of 10 trades. That's doable. But at one-to-one risk to reward, you need to do this pretty much all of the time in order for you to make money, right? And the thing with the market is the market's random. Market conditions change. Whenever you decide to commit to a particular strategy, understand that that strategy is going to be more profitable in some market conditions and less profitable in others, right? For example, my strategy is more profitable in a trending market, right? It works really, really well when the market is just trending. Okay. And so when you understand this, you understand that, hey, no matter the strategy that you have, no matter how good it is, right? The only thing that I can guarantee you when it comes to trading is that at some point in time, you are going to lose money, right? Some people hear that and they don't like that. If you don't like that, this is the wrong game for you, right? If you can't take that, this is the wrong game for you. That's the only thing that I can guarantee you in trading is that at some point in time, some of your trades are gonna lose. It's just you gotta bite the bullet. So, if we understand this, we want to start to think, okay, how can I be good at losing? That's where risk management comes in, right? The best loser wins in this game, not just on a risk management standpoint, but also on an emotional standpoint when we touch on discipline, right? The best loser comes out on top. The best loser wins in this game. How good are you at losing, right? And so it's understanding that, okay, how am I going to manage my risk? Do I want to fight an uphill battle? Do I want to have to win more than I lose all the time in order for me to make money when I know things happen, right? Life happens, market conditions change. My strategy does good in some conditions, it does okay in other conditions. All these different factors, right? Trump's tweeting this. You just don't know, right? And so you got to be able to have a risk management plan that can weather any storm. Okay. So when we move up the ladder and we go to 1 to 2, we only need to win 40%, 4 out of 10 trades in order to make money. Okay. 4 out of 10 trades in order to make money. Now, this is where you start to get in a better spot because now you can be on the lower end of the win rate percentile and you start to see some results. Where, okay, for every $10 that I risk, I'm going to make 20. Okay. 1 to 3 is the sweet spot. For every $10 you're going to risk, you're going to target 30. Now, at 1 to 3, I call this the sweet spot because this is where you pretty much can be a what was 30% in school? What, D? Was that a D? This is where you pretty much can be a D student, if you will, when it comes to how many were you right on? And you can still see results. You can still print. Okay. This is that sweet spot. Raise a hands, right? Let me, or not raise a hands. Some of you guys got cameras on, some of y'all don't. Let me get a 3 in the chat if you would like to be if you would like to be able to still make money even if your win rate was at 30%. You're a D student when it comes to how often you're right in the markets, right? But you're still able to come out on top. Okay. Now, 1 to 4, 1 to 4 is where magic really starts to happen. Like this is why I target 1 to 4s as a base, right? If you don't know that, you do now. 1 to 4 is where the magic really starts to happen because now you're telling me that I could win 2 out of 10 trades and I could break even, right? No harm, no foul. I didn't make any money, but I didn't lose any money, right? A day that you don't lose money is still a winning day, right? 1 to 4 is where it really gets magical, okay? Because 30% win rate, and that's where it really gets fun because let's say you're brand new to this strategy. You're just learning about tape reading. You don't know anything about smart money. It's gonna take you time to work through it, understand it, build your system and everything like that, following the steps that we give you guys. And in that time, there's going to be errors. At the end of the day, you're human. There's going to be times where you mess up. There's going to be times where you get something wrong. There's going to be times where maybe you were in a rush, you were analyzing too fast. I know that happens to me, and you miss something, right? There's going to be times where just different variables that happen are going to happen, right? And maybe it influences you or it causes you to overlook something where you take a losing trade, whatever the case may be. When you're at that 1 to 4 spot, it allows you to truly weather the storm, especially in your learning curve where you're still learning to get consistent with a particular strategy. When you're at that 1 to 4, right? This ain't stream, so I can be real. When you at that 1 to 4, you got room to fuck up, pretty much. Excuse my language, but you got room to fuck up, okay? And that's what you want, especially as a new trader. You want to give yourself room to fuck up because you will, right? 1 to 5, 1 to 5 takes a bit more patience depending on your strategy, but 1 to 5 is pretty much the creme de la creme, man. Like 1 to 5, you going after 1 to 5s. Even winning out of 2 out of 10 trades, you can still print something, right? But understand all this that I just showed you guys and I just explained, none of it means anything. None of it means anything if you're not truly risking 1 to 4 or 1 to 5 or 1 to 3, right? And what I mean by that is if your one changes consistently, this is where traders are fighting an uphill battle. And this is what I mean by that. Because a lot of people, when they're like, yo, I go after 1 to 4, 1 to 5, whatever the case may be, they don't realize their one is changing. And because their one is changing so much, it's really not, they're really not going after 1 to 4. Right. And that's what I mean by this. All right. Let's talk about it. Let's break this down. Right. Because trading is truly mental, right? Just like life. They say in life, right, that it's 20%. And they say pretty much in life that the things that happen to you and how you deal with them is what matters more, right? And so 10% of it is what actually happens, and 80% of it is how you deal with it, right? In trading, it's pretty much the same way. Okay. In trading, it's pretty much the same way. And so I'm gonna give you guys a scenario, okay? Now, let's say, for example, okay, let's say you can apply this to any strategy, right? But let's say you take a trade, okay, and that trade is a winner, okay. That trade's a winner, and just for the example for like simple math and stuff, let's say you take a trade, that trade's a winner. Let's say you risked $10 on the trade, right? And you decided to target $30 on that trade. Okay. So you made $30 on the trade. Okay, cool. You made 30 bucks. Let's say you take a second trade. Okay. Another 1 to 3, you risk $10 for 30 bucks. All right. Boom. You made another 30 bucks. Okay. So now you're up 60 bucks, right? Now this is what happens a lot of the times with traders. And this, a lot of the times, this can happen after a winning streak, and I'll give an example for the latter of things. But the strategy is working. We're following the strategy. We went through the course, whatever the case may be. Now you're hyped. You're like, yo, I just had two back-to-back winners, 1 to 3. I got this shit, right? And you're like, I'm new, so I start off small. I'm only risking 10 bucks, whatever the case may be. You get overconfident. You're like, okay, I'm actually gonna risk on this next trade, I'm gonna risk a little bit more. Okay. The next trade, you decide to risk 30 bucks. Okay. You risk 30 bucks, that trade loses. Okay. So now you're still net 30, right? No big deal, right? No big deal yet. Because it's like, all right, I made 60 bucks. I was willing to risk half of it. I'm up 30 bucks now. It's all good, right? Whatever. On to the next trade. And let's say that this next trade, you decide to risk 60 bucks, right? Now, you guys see where I'm going with this, right? Where you might be going after 1 to 3 still, but your one is changing, right? You're still going after 1 to 3. It's like, oh yeah, I'm going after 1 to 3, whatever the case may be. But that one that you're risking is not static. It's changing. When you start to do this, you're fighting an uphill battle as a trader. Okay, I'll give another example. Okay. This is probably, I want to say, a more common example for a new trader, right? You're just learning a new strategy. You just went through the course. It all is making sense to you. You're super excited, right? You decide to take a trade. You're going after 1 to 3 again, right? Again, you're still going after 1 to 3. You take this trade, you're risking, let's say on this, this is a new example, right? Scratch the other trades, completely new example, right? New psychological mind game, right? You're like, okay, I'm risking 30 bucks. I'm going after 1 to 3 still. Okay. So 30 bucks, you risk 30 bucks on the trade and you lose. Okay. Let's say the first trade you lose. Now, second trade, it's like, okay, cool, whatever. You're still super excited. You went through the course. Next trade, loses again. Right. Now you're down 60 bucks. In this scenario, most traders, the average trader, is probably going to lose confidence, right? When you have a winning streak, you gain confidence and you tend to risk more. When you have a losing streak, you lose confidence and you tend to risk less. This tendency of changing your risk based upon how you feel hurts your results as a trader. It doesn't matter how good your strategy is, right? Absolutely doesn't matter how good your strategy is. You could be at a higher win rate. You could be over a 50% win rate. You do this at a large enough scale and you're now fighting an uphill battle. So now let's say on that third trade, remember you were going after one to threes. You just took two losers. Okay. You just took two losers. On that third trade, because you're less confident now, you decide, I'm gonna go ahead and cut my risk in half. How many, like, let me get a three in the chat if you've ever decided, like, I like this trade, but I'm gonna cut my risk in half from what I normally do, right? Ain't that the winner all the time? I swear, every single time that jolt hit, like, that's the winner. That be the winner, yo. And because you cut your risk in half, right? So at first you were risking 30 bucks. You lost twice, so you're down 60. You cut your risk in half, so now you're only risking 15 bucks. You hit that one to three, you made 45, you're down. But you should be at break even, right? This same example, even if you were to be going after one to fours, the same example on that next trade that you decide to lower your risk on, right? That one hits. You're going after one to fours. You should, if you take three losers and then you take the fourth and it hits and you use that same risk, you make back your three losers plus profit, right? If we're going after one to fours, okay? But in that same example, if you cut your risk in half, you don't, right? Say you risk 30 bucks, you lost three times, you lost 90 bucks. If you stick to the plan, that's why discipline is a part of the equation, right? Discipline and reflection. If you stick to the plan and you decide to still risk the same 30 bucks, on that fourth trade that hits one to four, boom, you made 120. You lost 90 from the first three losers. You're net 30. You took four trades, you only won one. You still made money. But if you derail from the plan and you cut that risk in half, and now you risk 15 and you hit that one to four, you only made 60. So you're down 30 instead of being up 30, right? Now, there's a very good question in the chat. So someone said, what are your thoughts on lowering your risk for less probable setups? I think this makes sense because now your risk is changing based upon data that you might have on how probable a setup is. If you have actual data around like, hey, this setup is higher probability, then that is a concrete move that is being made by actual logic and not emotion. Okay. So, but this is my thing for that because you always want to allow yourself to be able to weather any storm. Your results are random. It's a random generator. It's very, at first, it becomes very hard to wrap your mind around. I know it was for myself, but your results are completely random, right? It's a random generator. And because of this, you want to stick to that risk as close as possible. So I'm a big advocate on, I don't believe in cutting my risk in half, right? Because that is too big of a gap in risk. Okay. If I go from like $30 risk to $20 risk, the numbers are still working against you, but they're not working as much against you if you go from like $30 risk to $15 risk, right? Because if you cut your risk in half, then you're also cutting in half the profit potential if that trade were to be a winner. Right. So I'm definitely a big advocate on if you're going to have what I call a range of risk, you want that range to be as tight as possible. Right. You don't want it to be from 50, from if we use percentages from 1% to a half a percent or from 1% to 2%. If you have a high enough run rate, then you can still be profitable doing that, but you're still fighting an uphill battle, and you would make more money if you just stuck to 1% in that particular example, or if you created a smaller range of risk. Okay, so hopefully that makes sense. But risk to reward doesn't mean anything if your risk is always changing. Right? If it's changing too drastically, then the risk reward is not really working for you, right? And so let's go back to the formula because we understand that the formula is strategy plus risk management times discipline plus reflection equals consistency. Okay, so we've touched on risk management and understanding that, hey, when it comes to this chart here, all right, I'll pull this back up one more time. Right? The sweet spot's going to be 1 to 3. Okay. 1 to 3 is going to be the sweet spot. 1 to 4 is going to be when things start to get magical. And then 1 to 5 is the creme de la creme, right? You're going after 1 to 5s. You really don't need to win that much at all. You don't need to be right at all to make money. You just need to be good at managing the money and staying disciplined in managing the money, right? So we understand that, and now we understand that, hey, this actually doesn't work for us if the one that we're risking is changing too much, right? If it's changing too much, okay? But now we need to understand the discipline of actually following that, right? Because the discipline is going to be the hardest part. It's where it becomes you versus you, right? It's where you are now, and I always use this analogy in trading. It's like when you work a job and you're not the boss, you just got to be good at following the rules. You have absolutely nothing to do with making the rules. But in trading, it's different, right? It's a little more difficult because you're pretty much the boss and the employee. You are the one that has to make the rules for yourself, but then you're also the one that has to follow those rules. Okay. And so when it comes to the discipline, it becomes you versus you, right? And reflection is going to help with discipline, right? Reflection is what helped me with discipline. And anytime I find myself slacking on my reflection, you notice that your discipline will fall off, right? One thing that a lot of people say is like, yeah, I want to master trading. And that's not something that I really believe in. Because I think we as people are forever going through different things. We're changing and growing at all times. And so you're never living the same moment twice, really. And so me 5 years from now still doing this pressing buttons, I'll be in a completely different mindset and headspace than me currently, right? And so it's important for me to reflect based upon my new habits, my new, whatever it is, my new thoughts, the way that I approach things, the way that I do things as me, right? So reflection is going to be important with discipline because when you reflect, it's going to help you to see a pattern in yourself. The same way that we can see a pattern in the market where we can see, hey, when the market does this and I see this on the volumes, typically this happens, right? The same way that we can see these particular patterns in the market that can help us make a decision is the same way that when we reflect, we can see these different patterns in ourselves to help us make a decision, right? And so reflecting is going to help with discipline, right? Whether you reflect daily, every week, every month, reflection is going to be a very important part of this formula, right? Because for y'all that have been on my streams, I'm sure you guys have seen me plenty of times say, like, I remember seeing this before, right? And I'm like, this is why I played this in this type of way, because I remember seeing this and I'll go back to that exact moment on the chart. And it's because I've reflected over it. And a lot of the times, things that I remember happening in the market, like the counter trend model, right? Some of you guys don't know about my counter trend model. It is what it is. If you don't, you're sleeping. But if you know about my counter trend model, that is one of my favorite models now, but it was one that tripped me up the most, right? Um, I used to lose a lot seeing whenever price would do a counter trend because I would look at it in a completely different way. And it was me being able to reflect on those things, but not just reflecting on things on a technical aspect, but on an emotional aspect, right? Me noticing that, hey, and I mean, this is just a common thing for most people, but noticing that, hey, if I got too much stress going on, emotional stress, I shouldn't trade. I notice, boom, I miss certain things, right? But being able to reflect on these different things are going to help you with discipline because when it comes to discipline, it's not just telling yourself to do something, but it's also allowing yourself to be in the right environment and the right headspace to make that something easier to do, right? Or to not do, right? I learned this from a book called Atomic Habits, right? If you have not read that book, I recommend that you read that book. If you're struggling with discipline in your trading, I recommend that you read Atomic Habits. But I learned in Atomic Habits that it's not just about having the discipline. Like if let's say you want to cut a particular habit, right? You used to be a big drinker, you want to cut drinking. It's not just about like being able to tell yourself, "Hey, I'm not going to drink anymore." It's also about putting yourself in the right environment to where it makes that easier for you, right? It makes that something that's more probable for you to do. If you want to quit a habit of drinking and you surround yourself by drinkers, you're fighting that uphill battle, right? Because you're working against yourself. You're working against the end goal that you have, right? And so it's the same thing for trading, right? If you know that, hey, you're someone that typically revenge trades, then I would say in that particular example, right? I would reflect on that and I would say, hey, when I'm upset or if I have something emotional going on, I'm not going to trade at all because if I lose, I'm now putting myself in the environment to give myself the opportunity to go ahead and revenge trade, right? And so it's reflecting on these things so that it can really help you when it comes to your discipline, right? Now, I promise you guys that at the end, I would go over something strategy wise. So I'm going to give you guys a quick little sneak peek into one of my entry models that is going to also incorporate some of these things that we just went over here. But save this. You guys want to remember that every part of the formula is going to be important in order to get to the end result of consistency, right? If you don't have a good strategy, or at least something that can produce a winning trade, um, then you having risk management and good risk management, yeah, it helps, and you could still make money with proper risk management, but it's a whole lot harder, right? It's a whole lot harder if you're just, I have no strategy, I only win 10% of the time. Your money making approach in the markets is solely going to derive from you being able to always manage money um, like to the T. It has like you're just at that point your strategy is not really giving you an edge. Okay. If you got a good strategy but you have bad risk management, then that doesn't really help either. Okay. If you have a good strategy and you have a good risk management plan, but you don't have the discipline to follow it, that doesn't mean anything either. Right. And if you're not reflecting to develop the discipline, then again, you won't get to the end result. So you need every single component to get to that end result of consistency. So with that being said, I'm going to go ahead and, I'll pull up an example here of one of my entry models, and I will pull it up here on USDJPY because We took this here today on the wait, what's today? Today Tuesday? Today's Wednesday. Today's Tuesday. Okay, cool. We took this today on the stream on Tuesday, earlier New York session to see this go to the upside. Okay. Now I told you guys that one of the keys with getting sniper entries is going to be aligning the higher time frame with the lower time frame. So I'm going to show you guys exactly how we did that here. I'm just going to switch to a different chart so I don't have to erase my markup. Am I like tripping or like, is this zoom? Is there like a squiggly line on here? Uh. There we go. All right. My bad. That distracted me. All right, cool. So let's make this super simple. Now, I like to objectively define structure in a particular way. I'm not going to go over that. That is not what this is going to be. That's a whole lesson in itself. Okay. If you want to know how I objectively define market structure, labeling higher highs and higher lows, then either tune into the Blueprint Wealth Conference or, go ahead and plug into these Zenrise streams. Now, asking the chat, this is pretty simple, right? Does this look like it's going up or does it look like it's going down? Right. Up, solid. Can't fool you guys. It's an uptrend, right? It's going up. Market likes to move in these waves. We're making higher highs and higher lows. So this what I like to do. I like to align the higher time frame with the smaller time frame. So I'm going to ask you guys on multiple time frames. So does this look like it's going up or does it look like it's going down? Up, still up. All right, cool. Boom. Does it look like it's going up or does it look like it's going down? Still got up. We still got up. All right, cool. Does this here look like it is going up or does it look like it's going down? We're still going up. We're still working our way up. Solid. Okay. How do I remove this tool here? This thing is in my way. All right, cool. Let's rewind this here. All right, cool. We're still going up. All right. Has it switched to down yet? Does it still look like it's going up? Let me know. Does this look like it's going up or does it look like it's going down on the time frame that we're on? Solid. All right, cool. Now, does this look like it's going up or does it look like it's going down? It's going down. So we just looked at several higher time frames. Daily, we said it was going up. 4 hour, we said it was going up, right? 1 hour, we said it was going up. 15 minute, we said it was going up, right? But when we came to these smaller time frames, like the 2 minute, the 1 minute, we said it was going down, right? We said it was going down. So I like to wait for the smaller time frame to align with the higher time frame. The higher time frame has shown me already that it's going up. But this smaller time frame has shown me that it is indeed going down. Okay. So I need to switch. I need to wait for this smaller time frame to get in alignment with the higher time frame. Okay. Now, there's time frames even smaller than this that I like to anticipate a break on. Okay. So this trade here, right? I had my zone. This is going up and everything like that, right? So this time frame, 2 minute, 2 minutes, going down, right? And I can see these waves. I can just see this doing this, right? I can see this doing that and making these little waves as it's working its way. Okay. Now, what I want to see from this point is I want to see this give a first sign that it wants to switch, right? And the way that it's going to do that is it's going to break the trend. It's going to break this, what looks like is going down. Okay. Now, I like to use these moving averages as well too as an extra confirmation, but you don't really need them. But a strong break is usually going to show us across of the moving averages. Okay. So when this first breaks, oh man, this is moving like molasses. It's my first sign that now we want to move back in the direction of the higher time frame. Okay. It's my first sign that now we want to move back in the direction of the higher time frame, but I don't want to just jump in, right? I want to get in at a discount. Okay. I don't want to just jump in, I want to get in at a discount. Now, what do I mean by that? Well, what is a discount? Okay. A discount is going to be anything under 50%. Okay. Right. 50% off is for me. Okay. Now you can use a fib to measure that and everything like that. I typically like discounts of a discount. So 50% is your average discount. 70% is a little better. 80% is like shebang, you know. 80% discount, just let me know. Nine in the chat if you went shopping, right, and you saw something that you wanted, right? Now, it was a particular price today, and let's say in the future from now, we got Friday coming up, right? And you see that that same item that you wanted is now at 60% off, 70% off. Okay. Doesn't it make sense? Like, let's say there's anything that you're thinking about buying right now that is actually useful, right? We're not talking about using Black Friday shopping for buying dumb stuff. Useful stuff. Let's say there's something useful that you need right now. Maybe you got free trading view right now. You need premium. Black Friday is coming up, right? Tell trading views, go ahead and send me promotion monies. But Black Friday is coming up. Doesn't it make more sense to wait for the discount than to buy it now if you know that Black Friday is coming up? Let me get yes in the chat, right? Yes, no in the chat if it makes sense to buy it now. Because that's how you want to be with trading, right? I like to be very stingy with my entries in the sense of I want to be able to be a buyer at the best particular price. And for me, that is going to be at a discount of a discount. Okay. I want the discount to be discounted, right? So that's going to be typically like below 70% off. Okay. So from here to here, right, 70% off is here. Right, that's about 70% off. Okay. So that's just about 70% off right there. Okay. And then we're gonna give this bad boy some room. Okay, rule of thumb is gonna be 3 to 5 pips. So if this says 76 and I add 3 to that, that goes to 106. Okay. There's that 1 to 3 just above those highs. Okay. So all we did here, super simple, is we just confirmed with multiple higher time frames of whether or not this was going up or down. And we just kept going down until we saw a smaller time frame that was going down. And then we waited for proof that, hey, it wants to switch from going down to going up. and then we waited for price to come to a discount of a discount. Okay. Now, all of this can be even more refined with things like volumes and tape reading to where you can make this entry even more precise. Before I knew volumes, this is all I would do. I would just wait for market structure like this. But now that we understand volumes, we can apply that as well too, and we can get even finer tuned entries because we can wait for proof that hey, this actually wants to move out of this area after it gets at a discount to get even lower entry and maybe even a higher risk to reward. Okay. But that is going to pretty much conclude this one, guys. Hopefully, y'all got some value out of this to understand my formula, my approach, my the way that I think to create consistency. Just being able to get these nice entries is not going to be enough, right? You definitely want to make sure that you follow the formula. But I'm gonna go ahead and pass it back to Junior. I